Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to begin our series on financial management officially. Now, even though we've done some one or two topics on financial management, we did not take it from the scratch, from the beginning, step by step, like the way we did with financial accounting and financial reporting. So here we are going to begin from the scratch, the introduction of financial management. That is what we are going to deal with. And so we'll start and then we'll build it up from there. So, introduction to financial management. Now, what is financial management? Financial management is two words put together: financial and management. Now, financial is from the root word finance, which means money. And then management has to do with the act of planning and directing and controlling affairs of something to achieve a particular goal. So if you want to put these two together and want to define financial management, we can say that financial management is the act of planning and controlling the financial resources of an organization or the monetary resources of an organization in order to achieve the financial goals of the organization. So that is what we can simply say is financial management. Planning, when we talk about management, we look at some key functions that are performed. And many of us are familiar with the planning, organizing, directing, and controlling as far as management is concerned, even though there are other functions that are performed. But if that is what we know, and we say that that is what management is about, and we do planning, organizing, directing, and controlling of resources in order to achieve a particular goal, and we want to look at management in the financial context, then we are saying that financial management has to do with planning and organizing and directing and controlling of financial resources, of the resources that are financial of an organization in order to achieve the financial goals or financial objectives of an organization. As we move forward in this lesson, we'll look at the financial goals of an organization. We'll look at financial management and its relationship with corporate strategy. And that is going to help us to understand some financial objectives of an organization. And we are saying that financial management has to do with putting together all these resources in order to achieve the financial objectives of an organization. And so financial management, as I have defined or explained, is basically about the management of all the monetary resources of an organization, both in the short term and in the long term, which includes the sourcing of funds, the destination of funds, and even the ultimate outcome of wherever we put in. So in other words, the financing, where we do the investment, and even when there are returns, how is it distributed or utilized? That is what financial management is about. Now, there are three key decisions in financial management that are made. When we say financial management, there are three key decisions of financial management. So, three key decisions of financial management. Three key decisions. Now, I said that we do the management of financial resources to achieve financial goals. Okay. Now, in doing that, we are concerned about the inflow of finances or the inflow of money or funds. Where is money coming from? We are also concerned about when the money arrives, where are we going to put it? In other words, investment. And then we're also concerned about the returns from whatever investment that we have made. And also, it even includes not just the returns, but how the returns are distributed or utilized. Okay, so it brings us back to the fact that when it comes to financial management, financial managers are faced with three key decisions to make. And that is what we are going to delve deep into as far as this video is concerned. There are three key decisions, and I'm going to list it in a particular order. Okay, the first one is the investment decision. The investment decision. And then we can also talk about the financing decision. And then finally, we talk about the dividend policy decision. Now, these three are key decisions. They are the three key decisions of financial management. Three key decisions to be made by every financial manager: the investment decision, the financing decision, and the dividend policy decision. Now, I'm going to explain to you briefly, but then I'm going to now pick each of them one by one and go deeper into what it's entails. So what is investment decision all about? What goes into making that decision? Financing decision, what goes into making that? And then the dividend policy decision. So basically, what is the investment decision about? Investment decision is basically a decision on where to put your finances, your available funds. So you want to make an investment and you are asking yourself, where should I put the money? So are you going to invest in asset A or asset B? Okay, you are faced with a lot of alternatives and you have, each of them comes with its own return and risk. Okay, now the decision as to where I should put the money in order to give me a return, whether it is in capital asset or financial asset or whatever, is called an investment decision. In other words, where am I going to put the money? Then financing decision is all about where am I going to get the money from to put into the investment. So I make a decision. So let's say an investment decision, I made a decision that, okay, I want to buy a bus that will carry people from Accra to Kumasi, okay, on a daily basis. So it will be on road working and to give me a return. So that is an investment decision. But the financing decision becomes, where do I get the money to buy the bus? Where am I going to get the money? Which sources of money or which sources of finance should I consider in order to buy the bus? That is the financing decision. And then dividend policy is that after the bus has given me a return, what portion of the returns do I pay the shareholders? And what portion should I also retain? And what criteria should I even use to pay the shareholders? So these are the three key decisions that we are going to look at. I'm going to pick each of them one by one, and then I'll take them as a subtopic and treat it on its own. Okay. Now, we are going to pick we are going to begin with the investment decision and delve deep into it. Now, what is an investment decision? I've explained before that deciding where to put the money in order to give you a return, basically. Now, in making an investment decision, the financial manager can invest in one of these three areas. Okay, now there are three key areas where you can do your investment. Okay, so it's either you are investing in one of these, or you can even invest in one, more than one, or even all the three. But I'm going to show you three key areas where we make investments. And the first one is that the financial manager can decide to invest in capital assets. Okay, so these are three options. Let me call them options. You can invest in capital assets, or you can invest in working capital, which is always essential, or you can invest in financial assets. So basically, I'm giving you three options for investment decisions. So as a finance manager, if you want to make an investment decision as to decide where to put your idle funds or money into to yield a return, you are either supposed to invest in, you can decide to invest in a capital asset, or you can just put it in working capital, or you can invest in a financial asset. Now, capital assets and financial assets are what usually comes to mind when we talk about investment decision. Many of us do not pay attention to working capital, but working capital is also a very good area for investment, depending on how well you do proper working capital management and projections. Okay, so you can decide to invest in capital assets, you can decide to invest in working capital, or you invest in financial assets. Now, what is the difference between capital asset and financial asset? Now, let me talk about working capital first, and then we can now talk about the capital assets and the financial assets. Now, working capital is basically asset minus liability, current asset minus current liabilities in accounting. So current asset minus current liabilities. So basically, working capital has to do with your inventory, which is an asset, your receivables, which is a current asset, and then your cash. These three things makes up your current assets. When we talk about your current assets, we are talking about inventories, receivables, and cash. And then your current liabilities, we make reference to payables. So in other words, the total of this minus the total of that gives you your working capital. So anytime we think working capital is basically your current assets minus your current liabilities. And if you do proper working capital management and you invest the right amount of money into your working capital, it's going to give you the optimum returns from the investment that you have made, so that you solve your problem of insolvency. Now, that is what working capital is about. I'll pick it and then I will delve deep into it. And then let's look at capital assets. What is capital assets about? Capital assets are basically non-current assets. When we say you are investing in capital assets, you are investing in non-current assets. So any investment in non-current assets are called capital assets, especially the tangible non-current assets. And capital assets are assets that the business will acquire with the aim of making some returns or profit out of it. So you acquire the non-current asset and use it to do business with the aim of making a return. So if you buy like the road bus that I spoke about, if I buy a bus and put on the road to work for me, that is investment in a capital asset, because it's a tangible non-current asset that I have bought, and that is going to give me a return on my investment. So you decide to invest in a tangible, a non-current asset to give you a return. We say you have invested in a capital asset. Now, working capital, I have explained that one is about the organization, your daily activities, how you are able to pay your short-term debt and then get your short-term resources. It's all about the management of working capital, and we'll get there. And then when we talk about financial assets are investments in any other asset that are not capital assets or working capital. In other words, financial assets is when you put money in a financial instrument. Okay, when I say financial instrument, you invest in shares, you buy bonds, government bonds, treasury bills. You know, many of us, when we have idle funds, we want to put it into a treasury bill, or we buy some shares in another company that will give us a return. When you put money into those kind of financial instruments, we say you have invested in a financial asset. So whenever you think about making an investment decision, you are faced with either investing in a capital asset, investing in financial asset, or just putting it in working capital. And these are the three options under investment decision for a financial manager to make. Now, I'm not just ending with this. I'm still on the investment decision. I'm going to take this in turns, and I'm going to look at the factors to consider to invest in any of these three assets. So we're going to begin with the capital asset. What factors do you consider before you invest in a capital asset? What factors should you consider before you make investment in working capital? What factors should you consider before you make investment in a financial asset? That is what we are looking at right now. We are still under the investment decision. Now, we are looking at factors to consider in making a decision to invest in a capital asset. We have said that under the investment decision, you are likely to invest either in a capital asset, in a financial asset, or in working capital. These are the three options you have. And we are saying that to invest in a capital asset, these are the factors you should consider in order to invest in a capital asset. Now I'm going to list them and I'm going to take my time to explain. So factors to consider in making a decision to invest in a capital asset. Take note. Now the first one is return. You consider the return that the investment is going to give you. And then also you consider risk. I'm going to explain them. So you consider the return on the investment, you consider the risk associated with the investment, and then you consider the short-term profitability. I'm going to explain. And then finally, you also consider the liquidity aspect. Now, these are four key things you must consider before you make a decision to invest in a capital asset. And all these things are exam areas that you should take note of, because there are theories that can be asked in the exam. So please take note. In order to invest in any capital asset, whether you are building a machine, you are buying a motor vehicle, you are building a house to rent as an investment property, all those are capital assets. Before you make a decision to invest in any capital asset, you need to consider first of all the return. The return on the investment. Now, what is return? Return is basically the long-term profits that is going to be generated from the investment. And I'm using the word long-term. That is why I brought in the short-term profitability. Because most of the time, when we are investing in capital assets, the benefits are not immediate. The benefits are in the long term. Now, it's basically the profit. This return is basically profits in the long term that is going to be generated from that particular capital asset that you are investing in. So if you build a house to rent, in the long term, are you going to recoup your benefits, and by how much and to what extent? By how much let's say by what percentage are you going to recoup your investment and then get enough profits? So that is what we call return. Return could be measured as a percentage. Now, in measuring the return of investment in a capital asset, there are two ways that you can go about it. You can look at the normal accounting way of measuring profit. So you can look at the accounting rate of return from investing in a capital asset, or you can use the net present value method, NPV. So when we want to look at investment in a capital asset, there are two options that you can calculate the return. We can calculate the return as an accounting rate of return, or we can use the net present value, which means that the positive inflows are more than the negative outflows. So that is what we are trying to say. Now, we are on factors to consider in making a decision to invest in a capital asset. And I'm saying that the first one you need to consider is return. So before you make any investment in a capital asset, you have to calculate either the accounting rate of return or the net present value of that investment to be able to determine whether the returns satisfied your expectations before you even embark on putting your money into that particular capital asset. Then again, you consider risk. Now, what is risk all about? Risk is the chance that the actual returns will be different from the expected returns. Now, remember that we are going to calculate a pre-defined expected return before we decide to invest in a capital asset. Now, risk is the chance that this return, let's assume that we calculated and we said that we are expecting a 40% return on the investment. So whatever money we put in, we are getting 40% as profit. Now, risk is the chance that this 40% will not occur. There will be a difference. It may be lower or higher, but what we are trying to say is that risk is the chance that there will be a difference in the actual returns we will record from the expected returns. It will not be the same. So there will be a difference between the actual returns and the expected returns. That is what we call risk. Now, risk is not just a feeling that it will be changing, because now risk can be measured quantitatively using the standard deviation. So now we can use the standard deviation to measure risk quantitatively. So the risk I'm talking about here is not something that you feel that it might occur or may not occur. It's not something that you feel may occur or may not occur. It's not about feelings. It is actually a quantitative measure. It is the chance that is measured quantitatively through something that we call standard deviation, which we are going to look at under the topic of risk and return. So we'll look at it. We are going to treat risk and return as a topic on its own. Okay, but here I'm just taking you through the fundamentals, the basics of what that we are going to look at as we move on. So we consider the risk, and I'm saying that risk is the chance that the actual return might not be the same as the expected return. And we are saying that risk can be measured quantitatively through the standard deviation. Okay, so that is what we are talking about. So we consider the return before putting money in any capital project. We consider the risk, and then also we consider the short-term profitability. Now, even though I have said that when we are investing in capital projects or capital assets, we are mostly focused on the long-term profits. However, it is also important to keep an eye on the short-term profitability. Okay, if the business is making no profit or little profit at the early stages of its life, it's likely that because it's not bringing in enough at the early stages, we may not have enough money to continue financing the project to the end of its useful life. So in as much as we are interested in the long-term profitability, we should also be somehow concerned about the short-term profitability that will give us that sustaining spirit till we get to the level where it begins to boom. If you look at even the product life cycle from strategic management, you realize that at the early stages of every project, there is some kind of low profits. However, the low profit should be enough to sustain the project till we get to the stages or the expected areas where we are going to have enough profit. So short-term profitability, even though it's not the main reason why we are investing, should be considered. If the project is not going to bring any significant short-term motivation or income for us to sustain the project, then we are going to struggle to actually sustain the project or the capital asset. And that is what we talk about. You consider the short-term profitability as well, even though it's not so important, because some projects may give you negative cash flows in the first 5 years, for example, and then from there it begins to give you what you expect. And then we also consider the liquidity. What I mean by liquidity is that even though we are investing in a capital asset, however, we need some level of working capital, because as we have brought in a new machine, it means it calls for an increase in working capital. So there will be an investment in working capital. Even though the main focus is investing in a capital asset, there could be some additional investment in working capital, which we should also consider. If you realize that bringing in that new machine is going to put a strain on our working capital such that we are going to have liquidity challenges, then we should avoid that project. Okay, so we should consider the fact that we need some extra working capital to sustain the capital asset. And that is what I'm talking about. Now, these are 4 factors to consider in making a decision to invest in a capital project. However, the first 2 are the most important one, because we always look at the relationship between risk and return, which I'm going to look at as a separate topic on its own. Okay, now these 2 are also supporting. It's important, but the 2 key ones that you need to consider. But in an exam, like I said, you can be asked to mention 4, and these are the 4 factors to consider in making a decision to invest in a capital project. So now that is it with the factors to consider in making a decision to invest in a capital project. I'm going to look at the next one, which is working capital. Factors to consider in making a decision to put your investment in working capital. That is what I'm going to look at. Okay, now we are looking at factors to consider in making a decision to invest in working capital, still under investment decision. So we have not even touched on financing decision yet. We are still under investment decision. And we are saying we are looking at the factors to consider in making a decision to invest in working capital. Now, there are only 2 factors here that we consider. The first one is that we consider solvency, and then we consider profitability. You need to take note of these things. Solvency and then profitability. Now, in making a decision to invest in working capital, we look at the solvency. What is solvency? Solvency simply means your ability to pay off your debt, your short-term debts, as and when they fall due, to be able to finance your inventory and then pay your payables when it's necessary. Now, if you put too much money or too little money in working capital, let me say, it means that you become insolvent. You will not be able to pay your short-term debt as and when they fall due. So before you put any money in working capital, you consider your solvency. How much investment in working capital do I need in order that I'll be able to pay off all my short-term debt as and when they fall due? That is because there is also risk associated with putting too much money in working capital. Okay, so there are some of these things, we will look at them when we are dealing with. There is a topic called working capital management, which we are going to look at in details. Okay, I've told you that we have started the financial management and we'll go to the end. So we are going to look at working capital management as well. So solvency is what I've explained. You should be able to pay your short-term debt as and when they fall due. If a business is unable to pay, it means they have become insolvent. And that is what we say. So before you put any money in working capital, you think about the level that you need to become solvent. And then profitability. Now, working capital, putting money in working capital doesn't give you immediate profitability, especially when it is to support the operation of a capital asset. Because most of the time, the profit from capital asset comes some years later. So when you are putting in money in working capital, you should understand that putting too much money in working capital reduces profitability in the immediate or in the short term. When you put too much money in working capital, it reduces your profitability in the short term. That is one relationship you should understand. It may give you long-term profitability because of it supports a capital project, but it will reduce your profitability in the short term, which may cause you to risk becoming insolvent. So in other words, you look at your profitability levels, your desired profitability level should also inform you as to how much money you should put in your working capital. So solvency, profitability, two key things we must consider in investing in working capital, so that when we want a particular level of profitability in the short term, then it will show us or tell us how much money we should put in working capital in order to be able to achieve that level of profitability. Otherwise, we risk becoming insolvent. So they have that relationship. Solvency and profitability are the two key things we consider in making investment into working capital. And then finally, we are going to look at factors to consider in making a decision to invest in a financial asset as the last aspect of the investing activity before we move on to the others. So we are going to look at factors to consider in making a decision to invest in a financial asset. Okay, so we finally look at the factors to consider in making a decision to invest in a financial asset. Now, what are financial assets? I've explained to you: investing in shares of another company, buying government bonds, treasury bills. Once you are putting your money in a financial instrument for return, then it means you are investing in a financial asset. Now, there are three key things to consider in making any investment into a financial asset. Now, I'm going to list them in no particular order. When I'm done, then I'll show you how it will be in an order when you decide to invest in a short-term financial instrument or a long-term financial instrument. So when you are deciding to invest in a short-term financial asset, there is an order you have to arrange it. If it is in the long term, there is an order. But for now, generally, factors to consider in making a decision to invest in a financial asset. These are the factors. You consider the risk. You consider the return. As for risk and return, they will always come into play. And then you consider the liquidity aspect. So before you make any investment into a financial asset, consider the risk levels involved. You consider the returns that you are likely to get from the financial asset. If it is too low and not desirable, you don't put your money into it. If the risk levels are so high and you are risk averse, you don't venture. And then you consider the liquidity, the ability to convert that investment into cash when you need them. These are the three things you consider to make any investment into your financial asset. However, you can decide to invest in the short term or invest for long term. Now, to invest in a financial asset or to make a short-term investment in a financial asset, there are factors to consider. So you see, in exam, for example, you can be asked, mention the factors to consider or explain factors to consider in making a decision to invest in a financial asset. These are the three factors. You can list them in any particular order and nobody chides you, because the question is given to you that generally financial asset. But when the question is specific, that what are the factors to consider in making an investment into a short-term financial asset or making a short-term investment into a financial asset, once it is specific, you need to list it in a particular order. If they say long-term, you need to list these same three in another order. So they will be rearranged depending on whether you are talking about short-term investment or a long-term investment. But if there was no specific mention of whether it is short-term or long-term, then you can be free to arrange them any way you want and explain. So if you are asked to list the factors to consider in making an investment in a short-term financial asset or making a short-term investment in a financial asset, then these are the factors in this order. Then the most important thing to consider is the risk levels. You need to consider the risk first, and then the liquidity is the next most important one, and then finally the return. Now let me explain to you. If you want to make an investment in a short-term financial instrument, it means like you are buying a treasury bill, for example, 91-day treasury bill, 182-day treasury bill. Those kind of investment, your focus is not so much on the return. Mostly we make those investments because we have idle funds that we are not using now. We just want to put it somewhere and then reassess it later in some 6 months time. So if you are making such an investment into a short-term financial instrument, all that is important to you, the most important to you is that there are not too much risk levels so that you lose your money in the short term. So risk returns, you don't care about whether it's giving you 20% return or 5% return. Is not really your problem. You just want to put your money somewhere and take it back again most of the time. And so the most important thing to you is that the risk levels are acceptable, and then liquidity, because once you move away from risk, liquidity is more important to you than the return. What is liquidity? Your ability to get your money back when the time is due. So once the risk levels are low, if the 6 months is due, can I get my cash back? Can I get my money back in 6 months time? Can I convert? Because liquidity is the ability to convert it back to cash. So that is liquidity, the most important after the risk. And then return becomes the, so if you are giving me 20%, fair enough. So in order to make a short-term investment into a financial asset, this is an order of importance in terms of the factors you consider. Risk being the first, liquidity being the second, and the return being the last. Now, let's come to investments in a long-term asset, the factors to consider in an order of importance. Now, in a long term, nobody really cares about liquidity now. In the long term, the most important thing to us is the return. In the long term, we are interested in the returns, because I cannot put my money into an investment financial asset for 10 years and I don't care about how much I will gain after 10 years. So in the long term, everyone is more concerned about the return. So these same three, you see that now return has been elevated from the third to the first. And then after the return, we are also concerned about the risk. So risk becomes the second most important factor to consider when you are making a long-term investment. And then the last one, we talk about the liquidity. We are not so concerned about liquidity in the long term because we are not thinking about converting it to cash now. Okay, so returns is the most important in the long term, and then risk is the second most important, and then liquidity becomes the third when you are considering making an investment into a long-term financial asset. So I just want you to understand what we've done so far. Now, we are going to, this is just, all this that we have done is under the investment decision. And we are now down with what we are doing under investment decision. So we are moving on to the financing decision, but that will be in the next video. This will bring us to the end of the part 1 of our video on intro to financial management, the 3 key decisions. Now in the part 2, we will look at the financing decision, and then we'll look at the dividend policy decision as well, all in the part 2. Remember to subscribe to this channel if it is your first time. Share this video, let others also have a benefit. And until we meet again for the part 2, it's bye for now. Thank you.